Good afternoon, good morning, and welcome to the 2025 Veritas Investment Research Open House. Very excited for you to join us today. My name is Anthony Scilipoti. I'm the founder and CEO of Veritas. And today we have an action-packed session. I'm joined by three of my partners. I'm going to kick it off with some background, some histories to provide some context in what is Veritas. And then I'm going to turn it over to our head of research, Dan Fong, and he'll go through the particulars of our process. And then I'll turn it over to Darryl McCoubrey, who's the head of our energy and infrastructure. And then lastly, Kathleen Wong, who's our consumer staples and discretionary analyst, and she'll take us through her analysis of Couche-Tard, which is a perfect, nice example of sort of a deep dive into some of our work. All right, Veritas grew out of a forensic accounting practice. I'm going to take some of you back to a time perhaps you recall, which was during the 90s. There were a number of scandals at the time, things like Laidlaw and Lowen Group. And at the time, I was teaching at York University, and using companies like that as an example of how they were, what I believed, cooking the books. And our student, or one of our students at the time, was Michael Palmer, and he was head of research at a brokerage firm. And he said, can you write about these companies? And I said, sure. As myself and my partners, we were doing litigation work, so kind of teaching was something that we did on the side, and it's still a core part of the Veritas group. And the work that we do to help our investors, clients make better investment decisions. And so what we did was really in 1999, we started writing about research. And we started writing about companies at the time, things like Royal Group and Callnet, TLC, the Laser Center, IMAX at the time, talking about their governance, their cash flow issues, accounting disclosures. And really, as the next slide depicts, it's not rocket science. What we did was we looked back in time and said, accountants are worried about small details, and those reading our research, because that's what really made us different. We were paid by our investor clients. We didn't really care much that at the time, many of the companies we were writing about actually didn't really like us much. But we looked back at the information that was being presented by companies, and we said, wait a minute, the company reports $1, but really it's 95 cents. And if that's the case, then when we're doing our projections, we're going to use a different starting point. Perhaps we're going to change what we calculate as organic growth, et cetera. And that's really looking back to assess what's going to happen in the future. And as the next slide talks about, we go through and think about accounting and financial information. And really at the heart of it, we're looking at it differently. Everyone will look at, the financial information and quite frankly, today, not paying much attention to it. It's really a point for compliance. It's a numerical exercise that gets audited. Journalists quote it. Employees use it for their purposes of their stock options or various remuneration. But to us, as the slide points out here, it's a means of communication. It's the language of business. And so the better we understand the accounting, the better we're going to be able to make investment decisions. And as the next slide points out, our forensic approach is really about separating business innovation from accounting innovation. And, it's always my favorite question I always like to say, or anecdote is to say, what's your favorite accountant? And the one where you ask 2 + 2, and they respond, sir, anything you like. Because it's all about the gray area of the numbers that can be produced. And why do we do that, as the next slide points out, is that business innovation leads to earnings and multiple expansion, whereas accounting innovation, as we've seen so often over time, is just simply not sustainable. And at the end of the day, what we've proven over the last 25 years is that by avoiding the stocks that go down, markets really are there for so many reasons set that they go higher. So if we can just avoid those companies that are going to underperform, and really our calls on the sell and reduce calls are even have underperformed by more than our buys have outperformed, okay, then that's a key point of how we're going to save our clients money. As the next slide points out, our client base is wide. Start the core of its institutional clients, got about 75 asset managers, both large and small, all the way down to boutiques and family offices, representing over 2 trillion in assets. We do a lot of special services. I alluded to that earlier in terms of training, but litigation support. Our work has been actually used in various trials, whether that was SNC, the Valiant case, the Royal Group Technologies case. We've testified in those various cases. We have retail advisory clients. So we are exclusive to RBC Dominion Securities as a bank-owned wealth management platform, but our research is then available to Richardson, Edward Jones most recently, and also on Ventum. And then we have regulatory clients, so CPA Canada, we do work with the OSC as well, and also the Canadian Public Accountability Board. These are the auditors of the auditors, and they've been longtime clients of ours. At the end of the day, it's about managing risk. And let's go to the next slide. You know, I've always been asked, what is it? What's the special, the secret sauce? And really, it comes down to asking one fundamental question, and that is why. And the reason we continue to ask that question is because nothing happens without a reason. So at the end of the day, if you keep asking the question why, by the time you get to the point at which the company or you as the analyst or PM are unable to come to the answer, you've probably reached what the answer is. Over time, the business that we built, really the core of our business is our research business, which we started back in 2000, as the next slide points out. And then in 2018, we launched an asset management firm, which basically takes our ideas on the research side, packages them on to our into portfolios. We've launched a foundation in 2019 that basically uses our forensic approach to help donors make better donation decisions. And lastly, as I started out, we circle back to where we started as an organization. We launched the Veritas U, which is an online training portal. Let's go to the next slide. So ultimately, it comes down to why independent research, why Veritas research. You can get research on many places. It's available online on many different sources. When we think about it, it's because the first point here, doing it yourself doesn't mean you have to act alone. And you have to always ask yourself when you're getting information, especially financial information, what are the objectives of those that are providing you that information? When you're getting our information, you know it's coming from a place that says, we're getting paid by those that read our research. So our only goal is to help you make a better investment decision. The next point is, because passive investing won't always work. But passive investing has a place and it's grown. It's taken share from active investing for sure. But as I'm going to show you, the proportion that's made up of actual retail investors has continued to grow and actually stayed relatively constant over time, taking share from other pockets. And let's go to the last point here, because, and this one, has been somewhat of a contrarian view, but if you look over the last 3 quarters, Canada has actually outperformed. Our TSX index has outperformed the S&P 500, which is very interesting, not something that many would have expected, and something that we've been commenting to our clients over the last couple of years. Let me show you some graphics to make the point. The first thing, and this is cornerstone to a lot of work that we've done, this actually led to a new IFRS section 18, which is going to be coming out in the next couple of years. Companies are going to report the equivalent of some operating earning number that they will come up with. And that's now part of IFRS. And I'd like to take a lot of credit for this as an organization. We were the first back in 2016 to actually write the paper alerting securities regulators that we have a problem with non-GAAP metrics. In fact, today you can see the expansion of usage of non-GAAP metrics, both in Canadian public filings and also US ones. And then the next slide talks to the proportion of different investment buckets. And you can see that retail investment still makes up nearly 40% of the composition of North American equity float. So with armed with information which is unique, unbiased, and geared to making investment decisions, I think gives you a leg up on others trying to invest. Take the next slide, which pulls together sort of what's happened over the last 6 years. And I'll click and I'll show you here the performance. So if you click the first button here, you'll see that look, that's been the performance. Like, who would have known that we actually even had COVID? Okay, in this time period, they're going to be writing books about this time. That's the S&P, and in red now I'm going to show you the performance of the TSX. Not too shabby. In fact, if we look at the line graph of the two indices, you can see that the S&P 500 and the TSX up about 220 odd percent, and the S&P 500, if we show the lines here, up about 245 or 50%. So we're going to look back at this time and say, wow, this is amazing that we had COVID. And I think this is going to be the time when we're going to need information, where it's going to become not as easy as it has been in the past. And I'm going to make the last point here to bring this together, to compare Canada to the US. This just compares the performance of the TSX 60 to the S&P 500. And many will forget, although the US outperformed Canada, and you see the blue and red representing the two countries, the S&P 500 has outperformed Canada in most of the years since the financial crisis. If we show you I'm going to highlight in the next click here, you can see that in that time period prior to, and even including the great financial crisis, Canada actually outperformed the US. And I think in a period of higher inflation, in a period of higher interest rates, the Canadian exposure, especially to commodities, our banks, we're going to be in a position to perform better than what I think the US will do. With that, I'll turn it over to my colleagues here. Dan, over to you.
Great, thank you, Anthony. So I'm Dan Fong, Head of Research here at Veritas. Just to give you a little bit of a quick background on myself, I've been at Veritas for about 9 years. I started as a diversified industrials and large cap oil and gas analyst. And then since moving into the head of research role, we've transitioned substantially all of my coverage to other analysts. So I just cover a handful of special situations. And in fact, you'll be speaking with Darryl McCoubrey in a few minutes, and he'll take you through energy and infrastructure. And Darryl actually picked up the bulk of my energy coverage. Before Veritas, I worked at a hedge fund focused on special situation and catalyst-driven strategies. And then prior to that, I started my career as an investment banker, focused mainly on high yield and leveraged loan transactions with a bit of equity sprinkled in there. So I think Anthony's given you a great overview of Veritas. I'll just fill in a few details just to fill some of the gaps. So we are Canada's leading independent equity research firm. We have been in business for about 25 years, and in fact, this October, we celebrate our 25th anniversary. And as Anthony mentioned earlier, we've built a very broad and diverse client base. We are focused on Canada. We cover about 90 stocks in Canada, and it happens that those stocks cover about 90% of the TSX 60 index by market cap. So basically the largest and most liquid names in the country. So that's a quick snapshot on Veritas, quick snapshot on myself. But what really matters here, what really sets Veritas apart, really comes down to three things, right? The first thing is that we are independent and we're unbiased. We don't have any investment banking. We don't do any sales or trading. No M&A, no advisory, no corporate finance relationships whatsoever. So what that means is when we talk about a stock, when we write a report, there's no sales agenda. There is no hidden incentives. And I think a good example of this would be Brookfield. And when I talk about Brookfield, I mean the Brookfield entities. So you got Brookfield Corp, Brookfield Asset Management, as well as several of the other public entities and a whole host of private ones. Well, as an ecosystem, as a whole, Brookfield is very active, particularly in private markets. And for investment bankers, that is a very lucrative treasure chest full of fees, right? So when we look at Brookfield, we're a little bit more negative on that. We see several risks that we're not comfortable with. And what we find is a lot of our clients come to us because they're looking for an unvarnished, a clean, independent view on what's really happening under the hood so that they can manage their positions better. So the other big thing is we lead with forensic accounting principles. And over the last 25 years, what we've learned here is that accounting risk is often a leading indicator of operational and strategic risk. And that's important to us because, as Anthony mentioned earlier, accounting innovation is not sustainable, but business innovation is going to manifest into some sort of operational or strategic advantage, which ultimately will drive earnings, cash flow, and multiple expansion. The other thing we've learned here is that reported earnings don't always reflect cash flow reality. And that's also important to us because at the end of the day, we are fundamental investors and we believe that true economic reality will ultimately drive long-term value. A great example of this would be BCE. So when you look at BCE, when they report a free cash flow number, they make certain exclusions. One of those exclusions are lease principal payments. The thing about lease principal payments is, that's effectively rent. So rent for a cell tower, rent for a building, rent for some other facility. The thing about rent is typically when you don't pay rent, you don't get used to that asset. And if you don't have that asset, you don't have a business. And, by excluding these principal payments that, effectively inflates your free cash flow, whatever number that you report. And by extension, that makes your dividend payout ratio look lower and much more sustainable. Our analyst dug into this some time ago, and when he did the math and he recut the numbers, he realized that BCE's dividend payout ratio was actually hitting around 160 or 170%. He'd been calling for a dividend cut for some time. And what happened 2 months ago? Well, we saw BCE cut their dividend by 55%. The last big thing that differentiates ourselves is that we are more critical of the story. So we will do more to test the narrative, challenge the assumptions, which ultimately helps us identify inconsistencies. Because at the end of the day, management teams are storytellers by design, but we at Veritas, we like to think of ourselves as truth testers by discipline. And I think a really good example of this would be Teck Resources. So several years ago, Teck Resources came out and they gave us this narrative of increased copper demand coming from proliferation of electric vehicles, coming from Chinese real estate. They also told us that in South America, they were going to have this big expansion project at one of their key assets, which was going to increase production. This asset was going to come online, on time, on budget, at low cost. Well, our analyst dug into this, and when he looked at the EV narrative, he basically said, well, you know what, even if this happens, not going to be a big deal, not going to move the needle. And then he dug into China, and he said, yeah, China's a big driver. They account for about 60% of worldwide copper consumption. And yes, the real estate market is that key driver. But it's not so much the real estate market as a whole. It really comes down to completions. And when he dug into that data, what he found was the backlog of completions was running down. And as that backlog runs down, there's actually less demand for copper because, if you can imagine, you build the structure first, and then after you build the structure, you start putting in copper pipe to finish it. Well, that backlog was starting to dry up, so we didn't see a big impetus for demand. And the other thing that our analyst found was when he looked into the expansion project in South America, well, they had a lot of problems with their tailings dams, and they had a lot of operational issues. And fast forward 2 years later, today Teck is saying that this expansion project probably won't come on until 2027. It's significantly over budget, and it's not going to be a low-cost producer. So, we did a lot to test that. We did a lot to, really identify the inconsistencies. And over the last 2 years, if you've looked at Teck, it has significantly underperformed the broader market. So this is our ethos. This is how we approach things. This is how we think about it. And with that ethos, what we've been able to do is we've been able to help our clients avoid a lot of the big blow-ups in Canadian capital markets. So this is a list here of some of the larger ones that we've helped our clients avoid. And as Anthony said, in our view, a big part of outperforming the market over the long term is avoiding the blow-ups. Now, we talk a lot about forensic accounting. We talk a lot about risk identification and the blow-ups. But I don't want to give you the idea that we are negative all the time. We are not negative Nellies at all. We do like to play good defense, but at the end of the day, we recognize that we got to score some goals to win the game. And I think this chart here shows that really well. And what this chart shows here is our long-term track record here. So we've got our buy calls in the gray bars, and we've got our sell calls in the burgundy. And what you can see here is over time, we have our buy calls have outperformed the TSX index in virtually every time frame on this chart, or actually, in fact, all of them. And just keep in mind, this is a relative return, so it's relative to the TSX. In particular, I'd point out the 5 and the 10-year returns there. Between 170 and 360 basis points over a 5 or 10-year period. That sort of average annual outperformance can have a very meaningful compounding effect. And then on the other side, when you look at our sell calls, we've done quite well as well, right? So even over that 5, 10, and since inception year, between 140 or 116 and 520 basis points of underperformance, essentially saying if you avoided these stocks, you would have saved yourself quite a bit of money, right? So, question is, how do we do this? Well, it comes down to a handful of things. In terms of our approach, the first thing is independence. For us, we think that's a key structural advantage. So if you're a research analyst in a typical capital market shop, you have a lot of voices coming at you. You've got bankers, salespeople, traders, and your clients. And typically, when you're in that seat, you usually listen to the loudest voices, and usually the loudest voices are the ones sitting next to you. So your bankers, your traders, and your salespeople. At Veritas, we listen to one voice, and that's you, the client. The second thing about us, and the second thing that we do here is we are long-term fundamental analysts, and we do what you would expect us to do. We will dig deep into business operations, balance sheets, cash flow, capital allocation, that sort of thing. And all those things will inform our view of the business fundamentals, the key things that will drive, shareholder value, revenue growth, margin expansion, capital efficiency, right? And that will give us a view on the fundamentals. But we don't stop there. We take that further and we think about these fundamentals and we consider them in the context of valuation and expectations, because that matters too for security selection, right? Oftentimes you'll have a great company, but if it's very richly valued, it may not make a great investment. And the third big thing that we do is we keep an eye out for flammable items. And this is our forensic accounting chops in action here. And really this comes down to pattern recognition. We've been doing this for a long time. We have a deep experience here. We've got most of our analysts are either accountants or have deep accounting training. So we keep an eye for flammable accounting items, as we call them. Some of the things include here would be things like changes in disclosure. As Anthony said, nothing happens without a reason. So when a company changes disclosure for a legitimate business reason, that's one thing. But if it's for an accounting reason, that's a whole different ballgame right there. The other thing is non-GAAP metrics, and economic reality. I touched on this. I think Anthony as well touched on this, but that's a big thing for us, making sure that what they report actually aligns with true cash flow reality. And then another big thing for us is looking at capital allocation and how that matches up with corporate strategy. We're looking for consistency here. When we see capital allocation that is unaligned with corporate strategy, we start to get concerned, and then we start digging a little bit further, because that will often be a signal of a potential red flag. So one of the last things I wanted to leave you here with is how we deliver value for our clients. What do clients get out of Veritas? And certainly the research and the analysis and picking up the phone and speaking to our analysts, that is definitely a big part of it. But beyond that, a lot of our clients have told us that they get a lot of additional benefits, and I guess the research and the analyst access manifests into a handful of benefits for them, including most of these on the slide here. I'll just touch on a few of them here. The first thing that they tell us is time. Having Veritas in their back pocket, having Veritas at their side, is like having an extra analyst team without the overhead. So what that's what that enables is our clients are able to cover more ground. They're able to turn over additional rocks and look for and spot new opportunities or risk, or spend more time on other primary research because they've got us helping them on the side. The other thing that they tell us is truth testing and fact checking. So that's our independence. So they enjoy having us as a sober second thought versus the street, a sober second thought versus management guidance, and that really dovetails into risk mitigation. So helping them identify accounting and operational risk to avoid the bombs, to dodge the bullets, and to size their investments appropriately. Another big one that they've told us, particularly recently in light of Trump tariffs and Trump's revenge tax, is complexity, or rather unpacking complexity. So, what we like to do here is we like to dig into the hard stuff to help understand, how these things will impact investments. And, a good example of this would be on Liberation Day, we were staring down the pipe of 145% tariffs on China. Well, Kathleen, our consumer analyst, who will be up here shortly, well, she penned a report on the retail sector and how these tariffs might impact some of those companies. And specifically, she dug into where they sourced their goods from, where the sales were happening, and then trying to understand what that margin impact on these additional tariffs would be. And that was a very well-read and very timely report. And ultimately, she found that in a lot of cases, the stock price reaction was overdone, and a lot of these, on a fundamental basis, these stocks were oversold relative to what these tariffs might do to margins. And I think the last thing I'll just comment on here is a lot of our clients tell us that we help them outperform, right? So we do help them dodge those bullets, avoid those bombs. And that's on one side in terms of ourselves, but on the other side, as I showed you earlier, even our buy calls outperform over the long term. So we're proud to have been proud to be able to help our clients, in these fashions over the last 25 years. Just a little bit about our publications. This is a long list. We publish about 900 reports, videos, and newsletters per year. I won't go through this whole list. I think we'll be sending you a copy of this presentation afterwards. The only two things here that I would comment on are the two at the bottom here. There are V-list model portfolio and our S-list model portfolio. So our V-list is a concentrated portfolio of 12 to 25 larger cap names that are selected by our V-list committee. And if you have questions on that, we actually have 3 out of 4 members of that committee on the line today. So that would be Anthony, Darryl, and Kathleen. And then our S list is a curated list of all of our sell calls. And I'll just show you real quick here in terms of our V list. This is what the performances look like over the last, last 20 years or so. Our the V list performance here is in burgundy, and we've got the TSX index in gray. And you can see over the long term, the V list has really meaningfully outperformed that the TSX index. And if we look at the S list, same sort of thing here. Burgundy is our S list, our curated list of sells, and the gray line there would be the S&P TSX index. And as you can see, our sell calls are doing what they're designed to do. They underperform the TSX index. So essentially saying, if you avoided these names, you would have done quite well. And with that, I'm going to turn things over to 2 of our senior analysts. We'll start with Darryl McCoubrey and then followed by Kathleen Wong. And I think what you'll see here in some of the comments that they make is, our forensic approach here isn't just about looking at the numbers, but it's also looking at the industry, looking at the companies, and trying to uncover incongruities in either the strategy or maybe a regulatory issue and that sort of thing. But basically, I think what you'll see here is some really neat comments on how they approach their sectors.
All right, thank you very much, Dan, for the introduction, and thanks for everyone for joining here today. Excited to chat energy and infrastructure. I joined Veritas almost 20 years ago. Started as an income fund analyst specializing in power companies, mostly thermal, and then expanded to renewable power, regulated utilities, pipelines, both regulated and those under negotiated settlements. And then just recently this year, some of the larger cap oil and gas names in Canada, and those names I cover alongside my colleague, Will Guy. What I wanted to do today is give an abridged version of what we do in the sector. And it begins with a relentless focus on near-term risk and opportunity. And those tend to revolve around some of the key headlines that I'm sure most of you are aware of in energy this year. GDP forecasts have been constantly shifting, mostly downward after Liberation Day, and just given general unrest between nations and on trading policy. One of the biggest overhang, the predominant one that's prompted us twice to downshift our energy commodity price outlook, is the overhang of OPEC plus supply. You have millions of barrels per day with a marginal cost that's a fraction of current WTI price and Brent price. And so that's a significant overhang that mandated a lower outlook for our WTI price. Policy evolution is a really big theme. In the United States, since the recent election, we've seen a real tilt toward fossil fuels, I would say, supporting things like natural gas and oil development. And also a bit of a tilt away, both legislatively and on regulation for renewable powers, the technologies that are supposed to disrupt some of our legacy fuels. And lastly, infrastructure development and risks. Just today, you're probably reading the articles that I am on Enbridge potentially looking at a new large-scale export pipeline, but obviously wanting significant safeguards in place before it would ever commit to that kind of thing. And so before we get into kind of a detailed outlook on that stock, Enbridge, which is one that I like as a B-list constituent, I think it'll benefit. The themes that I think drive potential upside for Enbridge begin on the next slide. And this is where we challenge things in the longer term. They're related to every one of those stories that we just kind of went over that are impacting energy markets today. But this is more of a farther outlook into how energy markets could evolve towards 2050. This first slide shows that we don't just accept current forecasts by leading energy analytical organizations like the EIA and like the IEA. And the reason we don't is starting with their demand forecasts, we think they could be too low. When we compare the two forecasts, which are starting on the left side, the IEA and the EIA, both reference cases, base cases for them, we see a significant shortfall in compound annual demand growth forecast over the long term by those two organizations, compared to what we would calculate based on a line of best fit, based on a regression to real GDP per capita, and you have a real high correlation there. So we think, if anything, there's significant upside potential maybe to overall energy demand. This would support an idea of more of everything in energy. But if we go look to the next slide, when we delve a little deeper into how the supply stack is expected to evolve, the key is all about electrification, that electricity is going to dislodge some of the fuels that we're used to, the solid fuels, the gas fuels, and also obviously liquids. And within electricity markets, what we see is, if we go to the next slide, that some of the idea that maybe natural gas, for instance, won't grow as much, mostly because of concerns over emissions, kind of run afoul of cost comparison, especially in North America, where natural gas prices are relatively low. And so what this slide is showing you is that at a base case, based on analysis by the EIA, its levelized cost of electricity, natural gas remains significantly cheaper than competing electricity sources. And so what I think there is that we may see organizations like the EIA shortly up their forecast for natural gas market share growth in electricity markets. And that would serve as a big complement towards all the LNG export capacity that we expect to be developed both in Canada and the United States over the coming years. If we go to the next slide, just to illustrate one more advantage that natural gas has here at home, it's just direct heating. It's a significant cost advantage over alternatives, including electricity, which, again, if you want to build the cheapest baseload electricity to heat homes, it would also be fueled by natural gas. That cost advantage is one of the things that we think could unlock even more demand growth in North America. And this complements some of the big kind of stories like AI growth or EV-based growth. Just basic uses we already have today, that where gas is being held back mostly by regulation, subsidies towards things like heat pumps, all of those sort of things, especially in the US, could be going to the wayside a touch, and that would benefit natural gas. And as we go to the final slide, as a stock that we think will benefit from this theme of growing North American natural gas production, Enbridge stands out, even though maybe you don't think of natural gas when you first think of Enbridge. You may think of its liquids export pipelines, and there are more often in the media, Line 3 replacement, Line 5 integrity issues, etc. We see the liquids business as being relatively insulated from price risk. Although they are a common carrier, their tariff structure mimics what we see in like performance-based rate making for regulated utilities. And within that tariff, the most important construct is a target ROE. And the minimum of the target ROE is over 11%, which gives Enbridge a lot of room for accretion relative to its cost of borrowing of probably around 5%, even in a worst case scenario where volumes are taken off the pipeline and move towards maybe a new big one to Prince Rupert or something like that. But really the story here from natural gas is that when you look at the growth profile for Enbridge, 90% of its capital spending is in natural gas assets, even though natural gas probably represents just over half of its value. So it sees the opportunity. And a very important thing within this industry for all the stocks we cover, especially the infrastructure ones, is to have a balance sheet that's in order. And thankfully, Enbridge is at its kind of target debt to EBITDA, solidly investment grade. So they could potentially endeavor towards larger development projects. But our base case is more for some of the smaller organic growth prospects on the liquid side and also on the natural gas side. I think Enbridge thinks it can get 300,000 barrels per day of additional volumes out of Canada. With that, I'm going to pass it along to my colleague, Kathleen, who's going to go over consumer staples and discretionary.
Thank you, Darryl. Good afternoon, everyone. I'm Kathleen Wong, the consumer staples and discretionary analyst at Veritas. I've been covering the retail sector on Bay Street since 2000, and I'm with Veritas in the last 16 years. Prior to Veritas, I spent about 8 years at CIBC World Markets. So I currently cover 10 Canadian retailers, including the defensive names such as the big 3 Canadian grocers, growth stocks such as Dollarama, Restaurant Brands, and Alimentation Couche-Tard. So besides these 10 names, I also follow some of their peers in the US and Europe on the sidelines. So today, I would like to give you my thoughts on Alimentation Couche-Tard. So next, okay. So we downgraded Couche-Tard to a reduced rating on March 2024. So given the macro concerns, and it reported 2 consecutive quarters of negative merchandise same-store sales in the US at the time. And the stock was trading close to our target price of $80 at the time. Since March 2024, Couche-Tard reported 3 more quarters of negative merchandise same-store sales in the US. We upgraded Couche-Tard to a buy in March 2025 after it reported Q3 results and the stock traded at about $71. And the upgrade was based on 3 reasons. So number 1, so Couche-Tard merchandise same-store sales in the US, excluding the negative impact of the significant winter storm, finally turned slightly positive at 0.2% in Q3. Couche-Tard reported its Q4 earnings this morning, and the merchandise same-store sales was slightly negative in the US at about negative 0.4%. But management mentioned on the call that it ended the year on a positive note with modest same-store sale improvement in the US. So that's a good sign. Number 2, Couche-Tard launched permanent meal deals in North America late last year. So we believe this has contributed to stronger same-store sales. Couche-Tard continued its rollout of the high-margin Fresh Food Fast program to its stores, and food service drive traffic and same-store sales. About 1/3 of Couche-Tard stores have adopted the Fresh Food Fast program, so there's still room to drive better merchandise same-store sales in the US. And number 3, Couche-Tard US fuel margins have been normalizing in the past several quarters, but remain healthy at 43 to 44 cents US per gallon in Q3 and Q4, maintaining a spread of 6 to 8 cents per gallon above Casey's. And Casey's is the 3rd largest convenience store chain in the US, trailing Couche-Tard. So the higher margins than Casey was mainly because of Couche-Tard rebranding initiative. Couche-Tard has been rebranding its gas stations to the higher margin private label Circle K fill. About 60% of the Couche-Tard gas station currently have Circle K fill. So there's more room for higher margins or sustaining these high margins. At the current stock price of $70, Couche-Tard trades at about 10 times EBITDA, a discount compared to Casey's at 14 times. And we believe the stock price reflected the lagging performance of Couche-Tard compared to Casey's. And I'll explain in the next slide. So this slide explains why Couche-Tard merchandise same-store sales and gross profit margins in the US have been lagging Casey's. 3 reasons. Number 1, Couche-Tard has a higher exposure to the lower income customers who represented about 50% of its customers compared to only 25% at Casey's. Number 2, Couche-Tard has a lower food service sales mix at 12% compared to Casey's at 28%. So this explains the 33% merchandise gross profit margin at Couche-Tard compared to 40% at Casey's. Number 3, Couche-Tard has a higher tobacco sales mix at 39% compared to Casey's at 18%. And tobacco has low margins, and the tobacco industry sales volume has been declining by about 9% per year. Next slide, please. So this is my final slide on Couche-Tard. It shows my thoughts on Couche-Tard potential acquisition of 7 & I Holdings, which has the largest convenience store chains in the world, 7-Eleven. Couche-Tard offered to buy 7 & I at about $18 US per share, or $47 billion US. And this implies an 8 times EBITDA multiple on a pre-IFRS 16 basis. This is in line with the low end of the 7 to 10 times pre-IFRS 16 EBITDA multiple that Couche-Tard paid for its previous acquisitions, such as Pantry in 2014, CST and Holiday in 2017. The 7 & I stock price currently is about 12% below Couche-Tard offer of $18 per share. We expect the acquisition to be mid-single-digit EPS accretive in the first year of acquisition, assuming that Couche-Tard will pay $18 US per share, assuming 80% debt and 20% equity financing. However, we believe the accretion can be even higher if we consider Couche-Tard annual free cash flow and the proceeds from the potential divestiture of 2,000 Couche-Tard and 7-Eleven stores in the US in order to satisfy the antitrust review. We published 2 Couche-Tard research reports on June 2nd and June 5th during a deep dive into the 7 & I, the 7-Eleven businesses and its strategies, and explain why we believe the 7-Eleven may appeal to Couche-Tard. So the report also includes the potential EPS accretion under various debt and financing scenarios. So to conclude, our buy rating on Couche-Tard is based on standalone fundamentals and does not include any contribution from the proposed 7 & I acquisition. So with that, I'll turn it over to Scott.
Great, thanks, Kathleen. This is Dan. Dan back here. I was just going to say thank you, everybody, for joining us. We hope we gave you a good flavor for Veritas, what we do, how we do it, and how we've been able to help our clients with make better investment decisions as well as improve stock selection. And with that, I think we're going to open it up for questions, and our moderator Scott will take any questions you might have, and you can just drop them into the chat box, and he'll read them out. And happy to take any questions at this time.
I don't see any questions just now, Dan. Of course, we're going to follow up with everybody, and it's a good chance. Oh, we do have one. Can you speak more about the Canadian housing market riskometer, the quarterly reports that Scilip does?
Yeah, sure. Anthony, do you want to take that, or would you like me to? I take it. So our bank analyst, who also covers our REIT sector, every quarter he'll dig deep into Canadian real estate data, and he's mainly focused on major metropolitan areas, but he'll also branch out into other aspects of Canadian real estate. But effectively, what he's tracking, what he's looking for, are signs of duress or signs of opportunity. More so duress these days, but tracking a number of different statistics, including pricing, listings, and using really his proprietary calculations to identify how long listings are on the market for, how and what that correlates into in terms of what you would expect for potential price appreciation or price declines. So that comes out every quarter, and it's something that we just started fairly recently, and that kind of dovetails into our annual real estate conference, which we hold every year in October. So as you know, Canadian real estate is somewhat of a national pastime for Canada. So it's been a very helpful, very interesting read for a lot of our clients.
And I would just add a quick bit of color there. Sorry, I was on mute. Can you hear me now, Dan?
Yes.
Okay. I'll just make the point that it's interesting because he's able to bridge the gap, not with the TREB data and that comes out along with the different municipal datas, along with what the banks are saying, and I think that's really where we can really add value in the way we're looking at the real estate market, and it branches not just into residential, but in all the four industrial classes as well, where we're looking at multi-res, retail, industrial, and what did I miss? And commercial. Oh, and office, pardon me. Well, I should call it that. Thanks, Dan. And thanks for the question. All right. I guess with that, thank you for your attention, your time, and your interest in Veritas. If there's any follow-up, please feel free to reach out. Thank you.